Hi everyone, I welcome you all on behalf of Felix Research for today's webinar. And the topic for today's webinar is Boost Your KLSE/SGX Trading or Investing Portfolio. So in this webinar, we would be discussing what kind of strategies and planning we should do, which will help us to grow our portfolio size and will also help us to reduce the risk on our trading or investing portfolio. Now, before starting today's webinar, I would just like to introduce ourselves to you, like what kind of business and services we provide. So the slide which you are seeing currently right now describe all those things and what kind of history we have, when did we start it, and what kind of services we provide to the clients. The webinar. Uh, the thing is, we all want to earn higher returns when we are trading in the market or when we are investing in the market. The main purpose is to earn higher returns and get some good profits. But due to lack of knowledge, due to improper strategies or wrong planning, we find it difficult to have getting consistent profits on our investment. And this webinar we would be discussing the same thing, wherein what kind of strategies and planning we should do, which will help us to earn higher returns on our investment. And not only that, what kind of strategies we should follow, which will not only help us to make good returns on the investment, but will also save us and will also help us to avoid the mistakes, the common mistakes which we do while making the investment. So our next slide for this webinar is equities or bonds. Now, generally, whenever we are starting or planning to invest in the market, the main question arises to every trader or investor is whether we should go ahead with equities or whether we should go ahead with bonds or warrants. Now, if you look into the overall picture, the equities are the one which provide high returns as compared to the bonds, the government bonds or the company bonds, whatever the bonds which you have invested in. But the other thing is that if equities are providing higher returns on the investment, they are also coming with a high degree of risk as compared to the bonds. The bonds, they come up with the risk which is on the lower side as compared to the equities, and the returns on bonds are less as compared to the equities. Now, as a smart investor, we should not put in all our money either into equities or either into bond. We should try to balance out the things, wherein we should keep a, a good number of some into equities and some good number of our money into bonds as well. This will help us to balance out the risk and will also save us from the volatility of the market and will help us to get good returns from the market. Now, if you look into the you know stats from the US market, like if we take an example from the period of 1926 to 2010, the average per year return on equities comes to around 9.9%, wherein in bonds it comes to around 5.5%. Now, if we calculate it after deducting the CPI and the inflation rates, the returns on equities comes to around 6.9% and the returns on the bonds comes to around 2.5%. So as a financial consulting firm, we always suggest our clients to not to put all the eggs into one basket, but try to diversify the investment and balance the risk factor and the market volatility factors. Now, after deciding on the ratios uh, related to equities and bond, the next question arises is what kind of companies we should select or what kind of companies we should have in our portfolio for investment purpose. Now, when I talk about the type of companies, I'm talking about the different class of companies. Now, different class of companies here means small cap companies and large cap companies. Now, small cap companies means the companies which are having low market capitalization or less market capitalization, they come under the category of small caps. And the companies, those who are having an excess capitalization, market capitalization, or a bigger market capitalization or a high market capitalization, they come under large cap companies. Now, as we have discussed in previous slide, that we should not put in all our investment into one domain. Here also, we should not put all our investment into one class of companies. Like we should not put all our investment into small cap companies, or we should not put all our investment into large cap companies. Here also, we would suggest you to diversify your investment, put in some money into small cap companies and put some money into large cap companies. Now, having said that, the small cap companies, they come up with a risk. The risk is since they are on the smaller capitalization, the the reason might be they are less established, the operations are not as big or as compared to the large cap companies or bigger companies. The track record isn't that attractive. That's why they are into small cap because they are not generating enough profit. That's what a simple definition of small cap companies come into. And when we talk about small cap companies, these are the risks which come along with the investment made into small cap companies because they are more volatile, they are more sensitive towards the negative impact of the market index. Now, having said that, if we go by the historical data, we would find that both in the domestic market, like Singapore, Malaysia domestic market, or international market, the US market, the Indian market, or the European market, the data shows that the investment or the portfolio which were having majority of their investment, like if we say out of 100%, the portfolios which are having more than 60% of investment into small cap companies, they have outperformed the returns to the portfolios which are having more than 60% of investment into the large cap companies. It's an irony, but the data shows us that investment made into small cap companies have provided higher returns as compared to the investment or as compared to the portfolios having majority of their investment into large cap companies. So before investing, we should always look forward for the stats and the historical data, and according to that, we should plan out our investment and we should manage our portfolio size. So our next slide is expense management. Now, expense management in a common term, we can say what kind of cost we are incurring while managing our portfolio. And since cost is involved, it then affect what kind of profit or losses which we are actually making on our investments. Now there are two methods by which we can go ahead with the expense management. The first method is the active management. Now, active management is somewhat related to hiring a professional or hiring or taking a service of a big research firm, maybe taking services of broking houses or investment bank while managing our portfolio. The cost of active management is quite high. The reason is that because when we are opting for this method, we need to pay high cost to the research analyst, to the expert, those who are sound enough into the technical analysis and the fundamental analysis. In some cases, it also involved economists, which study both the micro and macro factors while managing our portfolio. So since a lot of professionals are involved, the cost of active management becomes quite high, and this again will impact what kind of actual profit we are making. So let's say if you are hiring any technical expert and he is giving you some kind of advices on your portfolio. Now while you are making profit on your portfolio, you need to reduce the cost or the fees which you are paying to hire the services of this expert. So it definitely will affect what kind of actual profit or losses you are getting into your pocket. Now, other method is passive management. It is a substitute for active management, and it is cheaper and less costly as compared to the active management. And this method also helps you to avoid the risk of the market and to maintain a sound portfolio. So as a smart investor, we should opt for the best method which is suitable to our kind of investment, like what kind of investment we are making into the market. And we should also consider the actual profit and loss which we would be getting while opting for these two methods of maintaining our portfolio. Now, in this slide, we would be covering about investing in growth companies or growth stock, or investing in value companies or value stocks. Now, before moving further, let us first discuss what are growth companies or growth stocks and what are value companies or value stocks. Now, growth stocks are associated with high quality. Now, by high quality means the stocks of successful companies, those who are having good earnings, and the expected earnings in futures are also predicted on the higher side. That is, those companies which are very sound, which are having good profit making capabilities, those companies whose earnings are on the higher side, they come under the growth stocks or growth companies. Now, growth companies are generally associated with high PE ratios, high book value. Okay, and these companies generally they don't provide dividends. They believe in investing the balance earning into the capital gain. So the investors, those who are investing in growth companies, they generally make profit when the appreciation of this stock happens. Now, appreciation of this stock happen means that they invest in such company with the mindset that today they are having a stock, they are buying a stock at certain price, whose future price or the price in coming years would be much higher than what they have purchased in today. So those companies come under the growth companies or growth stocks. Now, other thing is what are values companies or value stock. Now, value stocks are somewhat opposite to what growth stock or growth companies are. Value stocks or the value companies are those companies those who are having low price to earning ratios, those who are having low price to book ratios. They the investors, those who invest in value stocks or value companies, they invest with the mindset that the value of the shares or the stock of these companies will move up or will increase once the overall scenario for the market becomes positive, or if we can say in general term, when the index starts to move further up and there is some bull rally in the market. These are the companies which are you know companies associated with dividend payouts also. So the other factor which the investors keep in mind while they are investing in value stocks or value companies is that they are expecting some dividend payouts, maybe quarterly, yearly, or half yearly dividend payouts. So, with that mindset, also investors they try to invest in value companies wherein they could get the investment, on the high. I mean, the returns on the investment on the higher side. Okay, now if we look into the historical data, we have found out that the portfolios, those who are having majority of their investment into value stocks, have given better returns as compared to the portfolios, those who are having a majority of the investment in the growth stock or growth companies, both in Malaysia, Singapore, that is our domestic market, as well as in the international market. And the main reason for is that the value companies or the value stocks have given consistent dividends as compared to the growth companies, which are not related or which are not associated with or which are not known for providing the dividends. So looking into this stats, we can easily judge out that what should be the our portfolio ratio when it comes to the investment made in value and growth companies. Now the next slide of our webinars is diversification. Now diversification is a very important aspect or a very important strategy which every investor should and must follow while he or she is going ahead to maintain the portfolio. Now, by diversification, we mean that investing into different asset classes and not investing all our in money or investment into one asset class. Now there are different asset class, there are different domain of investment which are available in the market. you know as we have discussed earlier also, like one can invest in equity, one can invest in bond, into small cap companies, into large cap companies. There are facilities available wherein you can invest into stocks which are not associated with your own domestic market. You can invest into international stocks also. You can invest into REITs, that is into real estate also. uh, there are good products or good assets available into the commodity market also. So the overall meaning is that we should not just focus on one asset class. That is, we should not only look forward for just investing into equities only, or we should not focus on investing into just uh, real estate, or into land, or into properties, or we should not just look forward for investing into commodities like gold, or silver, or crude. We should diversify the investment of ours into different asset classes. Now, this is very important because this not only help us to get higher returns on our investment, because when we are diversifying our portfolio, we are able to get the advantage of the appreciation or the movement or the higher returns of different asset class which are available to invest in the market. Along with that, it will also help us, the diversification will also help us to reduce the market risk. So for example, if currently the equity market or the stock market is not performing that well, and if you are having some sufficient number of investment made into commodity market like gold or like silver, that could compensate the losses which we are making, or that could also compensate the low returns which we are getting on the investment made into these stocks. We can compensate it by the higher returns which we are making on the commodity market. In the same way, if the commodity markets are not doing that well, or if the investment made into the commodities like gold, silver, crude, whatever it is, if not performing or not giving the returns as we were expecting, the investment which we have made into the properties, either in land or either into real estate, they could give good returns during that particular time, and hence we can compensate our losses or the low earnings which you are making on the commodities. In the same way, if our domestic market, the whatever market you trade into, is not performing well because of the local issues or local factors, and the stocks in some other market are performing well, you can invest into international stocks which we can get some good returns on that. There are a lot of people, those who invest their good portion of investment into the broader stock market like Nasdaq or S&P 500, etc. So the main purpose of diversification is to spread out our investment and take the advantage of the appreciation of different asset classes, and to reduce down the market risk which one asset class could provide. So diversification is the most important and a must-do thing for every investor or a trader when it comes to managing the portfolio. Now, the next topic which we would be discussing is rebalancing. Now, rebalancing means that to not just stuck with one portion of percentage into one particular asset. Now, by this I mean that, let's say currently you are having a portfolio wherein you are having 50-50 percentage of investment into bond and equities. Now, if currently the equity market are doing good, or there is a chance that in coming few years or coming days the equity market could perform well because of the good fundamentals of the particular market, then what one should do is, or what a smart investor does is, he tries to maximize, or he tries to increase the percentage into equities during that time. This will help the investor to to get the maximum returns on the investment and make the most beneficial use of the opportunity which the equity market is providing at that time. In the same way, if the equity markets are not doing well, or there are chances that in coming days the equity market could come up with negative return, then a smart investor, what he does is he shifts or he transfer his money from equity class to the bond market. This adjustment which are made into different assets during different market scenarios, is known as rebalancing, wherein according to the market condition, we are balancing our investment to the most profitable or most potential asset class. This is a very smart and very intelligent way to get high returns on the investment being made, and again it protects the investor from the risk of the market. So rebalancing is a very important part wherein one investor should always be ready to grab the opportunity which a different asset class is providing or expected to provide, and thus get high returns on the investment. This is a very important part, and we as a financial consultant, we would suggest each and every one of you to look into the rebalancing thing and try to implement it during your trading time also. With our today's webinar, the webinar here which we have conducted today was mainly to educate the investors on the different strategies which are available right now, which could help the investors or traders to increase the returns on their investment. Now, as you all know that managing the portfolio is a tedious job. It requires a lot of time. It requires a lot of study to be done. It requires a lot of knowledge also, which everyone is not capable of studying those parameters on, which would help them to manage a portfolio. But the simple strategies which we have discussed in this webinar will most definitely help the investors to increase the returns which they are making on the portfolio currently. Now, by following these simple strategies of diversification, of selecting the best classes of asset, and strategies like rebalancing will most definitely help the investors to gain extra 3 to 5% on their overall investment which they are making currently. So uh, I would suggest you that every investor should follow these strategies to their advantage and to maximize the returns on the investment. Also, investors should look forward for the expenses which they are incurring on their investment, because not each and every investors is having same kind of portfolio size. So depending upon the portfolio size, depending upon the purpose of the investment, and depending upon the future expenses which are supposed to come, one should try to minimize the expenses which an individual is making on managing the portfolio. So with this, we conclude our today's webinar. Uh, I thank you all on behalf of Felix Research for giving us an opportunity to conduct this webinar, and to thank you all, and hope these strategies will help you all in managing your portfolio. Thank you. Thanks a lot.